Welcome to today's video on the year-end 401k trap and how to avoid costly overcontributions when changing jobs late in the year. We'll explain why the payroll check date, not your bank's deposit date, determines which tax year your wages and retirement contributions belong to. We'll also walk through scenarios, share actionable steps, and test your understanding with short quizzes. Let's get started. First, we'll outline why changing jobs late in the year can unintentionally push you over the IRS 401k elective deferral limit. Next, we'll clarify why the payroll check date is the legal determinant for the tax year of both wages and 401k contributions, not when money shows up early in your bank. Then, we'll cover practical scenarios and safeguards, including how to handle automatic enrollment, how to temporarily opt out, and how to track accurately. Finally, we'll show what to do if you already exceeded the limit and confirm your understanding with quick quizzes. To begin, let's set the stage. If you switch jobs near year-end, even a small automatic 401k contribution at the new employer can trigger excess deferrals. This is because the IRS annual limit applies across all employers combined. The key is understanding which date controls the tax year. The payroll check date on the pay stub. That single date determines the year to which your contribution applies. Now let's make the risk concrete. The IRS annual 401k elective deferral limit applies across all employers combined. If you maxed out at your old job, a small automatic contribution at your new job can put you over. The consequences can include corrective distributions and complications on your tax return. Crucially, the official payroll check date on the pay stub is what determines which year a contribution belongs to, not when your bank shows an early direct deposit. Next, visualize timing with a timeline. Imagine your bank posts an early direct deposit on December 30th, but the official payroll check date listed on your stub is January 2nd. Even though the funds hit your bank in December, the contribution belongs to the next tax year because the check date is January 2nd. Conversely, if the check date is December 31st, but your bank shows it on January 1st, it still belongs to the prior tax year. This demonstrates that the check date governs the tax year assignment, not the bank's posting date. Let's examine common scenarios. Row 1. An old employer's check date is December 29th, so both wages and the $1,000 contribution count toward the current year. Row 2. The new employer shows money in your bank on December 30th, but the official check date is January 2nd, so the $120 counts in the next year. Row 3. Even if the bank posts on January 1st, a December 31st check date means the $500 is still in the current year. Row 4. A January 3rd check date cleanly puts the $300 into the next year. This table reinforces that the check date dictates the tax year classification. Moving on, remember your target, the annual elective deferral limit. For 2024, the elective deferral limit is $23,000, with an additional $7,500 allowed for age 50 and older as a catch-up. Employer matching contributions do not count against your elective deferral limit, though total plan limits still apply. Always confirm current year figures on the IRS website before adjusting your elections, especially near year-end. Next, here are defensive steps. First, verify your year-to-date elective deferrals from your previous employer. Second, immediately review the new employer's auto-enrollment policy, including start date and default percentage. Third, if you are approaching the limit, temporarily opt out until the new calendar year begins. Fourth, monitor the official payroll check date in your payroll portal and disregard early bank deposit notifications. Fifth, if you already exceeded the limit, contact your plan administrator and request a corrective distribution by April 15th of the following year to minimize tax complications. Finally, keep documentation, copies of pay stubs, correspondence with HR or payroll, and your own tracking notes. Quiz time. Which date determines the tax year for your wages and 401k contribution when there is a mismatch between bank posting and payroll? Option A, the bank's early deposit date. Option B, the pay period end date. Option C, the official payroll check date on your pay stub. Option D, the date HR processed the payroll batch. You may pause the video now to consider your answer. We will discuss the correct answer in the next section. The correct answer is the official payroll check date on your pay stub. That date determines the tax year for both wages and your 401k contribution. Let's compare the two competing dates. On the left, the bank deposit date is determined by bank processing timelines and may appear early due to promotional features. It is not authoritative for tax year classification and can cause confusion. On the right, the official check date is set by your employer's payroll, appears on the pay stub, and is the authoritative date for the IRS. Use the check date as your single source of truth for tracking contributions. Here is a decision flow. Start by checking your year-to-date elective deferrals from your old employer. If you are within a small margin, such as $500 of the annual limit, temporarily opt out until January 1st and then re-enable in the new year. If not, confirm the new employer's auto-enrollment percentage and whether any paycheck with a check date prior to January 1st will occur. If yes, opt out to avoid crossing the limit. If no, you can continue. Throughout, the check date is the controlling factor for timing. Now let's bust a few myths. First, it is false that a deposit hitting your bank in December automatically counts in December. Second, it is false that the pay period end date decides the tax year. Third, it is false that you can exceed the limit at your new job simply because it is a different employer. The IRS limit applies across all employers combined, and the check date controls the year assignment. This pie chart illustrates how contributions can be split between two employers in a single year. For example, $22,400 at employer A and $600 at employer B. If the combined total exceeds the annual limit, a corrective distribution is required. The visualization emphasizes that it is the combined total that matters. Here's your second quiz. You have already maxed your 401k at employer A by mid-December, and you just started at employer B with a 3% automatic enrollment. What is the safest move for the remainder of December? Option A, keep the 3% as if a new employer means a new limit. Option B, ignore it and sort it out at tax time. Option C, temporarily opt out and re-enable in January after verifying check dates. Option D, rely on bank early deposit dates to track your year. You may pause the video now to consider your answer. We will reveal the correct answer next. The correct answer is to temporarily opt out and re-enable in January after verifying check dates. The IRS annual limit applies across all employers. This approach prevents accidental excess deferrals and the need for corrective distributions. As a quick reference, here are Markdown-style notes you can copy into your personal tracker. Emphasize checking the check date on your pay stub, opting out if you are near the limit, and tracking combined contributions across employers in a simple table. Keep copies of your pay stubs and highlight the check date. Resume contributions in the new year when the check date aligns accordingly. If you have already exceeded the limit, contact your plan administrator and request a corrective distribution by April 15th of the following year. Generally, the excess amount is taxable in the year it was deferred, and any earnings may be taxable in the year they are distributed. You may receive corrected wage statements depending on your situation. Keep thorough documentation of the process and outcomes for your records. To wrap up the core lessons, the check date on your pay stub controls the tax year. The IRS elective deferral limit applies across all employers combined. When changing jobs near year-end, consider temporarily opting out to avoid excess deferrals. If you exceed the limit, request a corrective distribution by April 15th. Finally, track and document everything. Before we conclude, please note this important disclaimer. This video is for educational purposes only and does not constitute tax, legal, or financial advice. Consult a qualified professional for advice tailored to your situation. Always verify current IRS limits and your specific plan rules. In summary, the check date rules the tax year for wages and retirement contributions. Manage auto-enrollment carefully near year-end, and consider opting out until the new year if you are close to the limit. If you overshoot, correct promptly. Following these steps will help you stay compliant and avoid unnecessary tax complications. Thanks for watching. If this video helped you avoid a costly mistake, please like, share it with a friend who might be changing jobs, and subscribe for more practical money guidance. Tell us in the comments how you track check dates and whether you've run into early deposit confusion. See you next time.